While some online bullion dealers continue to charge $4 over spot for U.S. Mint Silver Eagles, SD Bullion is selling 2016 Silver Eagles for just $2.29 over spot for any quantity. Again, that's just $2.29 over spot for any quantity. If you haven't joined over 25,000 new customers by making the switch to SD Bullion, what are you waiting for? You could save hundreds or even thousands of dollars on your next order. SD Bullion, the lowest prices, period.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Well, Eric, it's been a strong week for both gold and silver. Really, over the past 7 days here, silver's up nearly $1.50. Gold's up almost $80. I guess it is $80, really, from the lows it touched here. So it's been quite a week for the metals after the horrific jobs report last week had the market sentiment totally shifting from expecting rate hikes next week to not seeing that as possible. So what's your take here on the metals as we close out Friday afternoon here? Gold trading right around $12.75 and silver right around $17.30.
Well, the bullion looks great. There's no doubt that we're seeing a lot of accumulation, and people are kind of edgy. We have Brexit going on later this month, and the latest polls are indicating that 55% want out. If you look at the financials over in Europe, they're kind of teetering again. So there's a lot of nervousness going around, and that's reflecting in the interest in accumulating bullion. It was nice to see the carry on from last week, as we were expecting to see. It's a little disconcerting at this point, though, to see today that we did see some efforts at capping, and if you look over in mining share space as well. Somebody about, I guess recording just shy of 3 p.m. on Eastern Time Friday, and a couple hours ago somebody dumped 85,000 shares of JNUG, which is a really, really large order, and who knows what the heck was going on with that. It could have been just, some hedge fund liquidating, or it could have been outright manipulation. I haven't had a chance to really dig into it and see if I can determine that, but there's been the cartel footprints, as we like to say sometimes, around the edges. So, we've seen a pretty decent move, and in the short term, it's really hard to see what next week is going to look like, because it looks like the kind of signals we look for in terms of trying to judge where the cartel may show itself are the kind of things like, for example, the large JNUG sale and the pressure in the mining shares across the board that we're seeing in this afternoon trade. But overall, the bullion looks good. We've seen gold and silver continue on 3 days in a row with generally higher prices over the previous day's trade, with general momentum continuing to accumulate. And that's a really nice traditional bull market pattern. And despite all of the commotion with the efforts to cap things, that continues, and it's confounding the skeptics, that's for sure. And if we move over and look into what's going on in the credit markets, the carnage there is pretty amazing. The German 10-year bond hit a interest rate today of 0.01%, the lowest, I believe, if I'm not mistaken, ever. It's just, like a sneeze away from going into the negative territory. The Swiss bond is now further into the negative. And the 10-year in the United States is also declining. And people are, the big money, the institutional players around the world are really nervous. And you see this move into the bonds today and throughout this week. It suggests that there's a lot of concern about the underlying health of global economic conditions. And then layer on top of that, we've got the Fed meeting next week. Day after that, Bank of Japan meets. As we talked about in the last show, there's just no way that they're going to raise interest rates, particularly with all of this stuff that's going on in the credit markets, and the Japanese yen as well moving higher today, which it's indicative of, again, these kind of global strains. Maybe we're even seeing a little bit of the Japanese carry trade unwind too, which, a lot of institutional traders had gone to Japan to borrow money in yen and then to go out on the world markets and buy assets. And with the European markets and the S&P 500 showing some weakness today, who knows? Maybe there's some of that carry trade unwinding today too. So bottom line is, overall the underlying nervousness is showing up in gold and supporting it in silver in turn. Another thing too that was kind of interesting is that going into the London PM fix and silver, it closed on the high. That's kind of unusual. Usually when we're looking for manipulation, we frequently see and in fact have now, have the benefit of Deutsche Bank being busted for manipulation along those lines. So all in all, I think it's a pretty decent backdrop, but it's kind of hard to see what exactly is going to happen in the very shortest of term trading, because next week there's just so much going on, and this is just one of those times where it's hard to tell that whether or not we're going to continue on with this nice 2-week momentum. But longer term, later in the month, going into Brexit, other than what may happen next week with the Federal Reserve and all the jawboning that may come in association, and I shouldn't even say may. I mean, they're probably going to attempt to whack metals, and jawboning may very well be the prime bat that they use to whack the metals next week. And I think we probably have a setup for that. So, but at the same time, it's really nice to see this momentum, and I think that the bullishness will continue. There's a lot of very large money managers around the world looking at what's going on geopolitically, financially, economically, and the momentum in the bullion as well, combined with people like Soros and Stanley Druckenmillers and so forth coming into the space, or like a big neon sign saying "Buy me." So Again, I've said this before. I don't think we're going to see summer doldrums in the gold space this year.
Yeah, it's been really amazing to me here watching gold's trading action, particularly this afternoon after a run up early in the COMEX, closed in on 1280, and then it was knocked down, lost most of its gains. And as you remarked before the show, Eric, it's really been a 45-degree angle since just before noon when it bottomed. I think it was around 1267, 1268. It's recovered probably 90% of that knockdown and just climbing steadily into the close and into the access market here. That's continued this afternoon. So definitely impressive action to me. And that's something that really over the past couple of years you haven't seen gold or silver trade like that after a takedown. Fully agree with you that we'll have to see with next week all of the news and Fed meeting the FOMC. Probably 80-90% of the time, the metals are knocked down no matter what they say, unless they announce QE1. So,
yeah, and the dollar has been catching a bid today too, which is something that's noteworthy because the metals initially they were slightly weak because of that, but then they just completely blew it off. And yesterday as well too, the strength in the dollar was something that was completely ignored. So it's overall a really good picture for next week. But then again, the 800-pound gorilla in the room is what the jawboning may in fact do, because they're definitely going to be doing a lot of jawboning.
All right, well, we want to give the listeners a quick update on the status of the bullion markets here in the U.S., and we've picked up on an interesting development in Silver Eagles over the past week. We've discussed week in and week out in the show here that really hasn't been any signs of the allocation ending because the U.S. Mint keeps producing at capacity and all the primary dealers keep taking down 1 million coins a week, as much as the Mint can produce. For the first time, we've had several early indicators or signs that may be about to end, and what's it been now, Eric? About 12 months of allocation and shortages for Silver Eagles may be about to end. If you look at the sales numbers for Silver Eagles, here on Friday the 10th, the Mint is reporting only 833,000 coins for June. That actually includes the last 3 days of last week. So it looks to me like they've probably only sold somewhere in the neighborhood of 600,000 to 700,000 coins this week versus the million they would have produced with 5 full days of production. Over the last year, they've been cranking out basically 200,000 coins per production day, or business day that they're open, minus any Columbus Day or semi-holiday that all the government institutions are closed on. We didn't have any this week, so if all the authorized purchasers would have taken down every coin they minted, you'd be looking at probably 300,000 to 400,000 higher sales totals for the week. And then the other thing we've seen in the market is two or three different of the APs over the past week have begun dumping Silver Eagles. And when I say dumping, they're not just pushing them out the back of their vaults, but they're selling them at or below their cost. And we heard directly from the head of the trade desk of one of those APs this week that the reason for their doing that and their strategy is they believe the allocation is just about to end, and they want to have their Silver Eagle inventories as low as possible when that happens so that they can purchase as many coins from the U.S. Mint as they can, because as soon as the allocation ends, the U.S. Mint recalibrates everything and they count up all the coins each AP buys during the times of when they can buy as many as they want. And that's how many they purchase during the normal times, or how the U.S. Mint calculates who gets the most coins and who gets how many coins during the next time of shortage. And the times of shortage is where the APs make all their money, when they're still buying for the Mint for $2 over spot, but instead of selling at $2.25 or whatever and making 25 cents a coin, the wholesale market is demanding $5 a coin. That's when the APs are making a killing. And so they know that.
The shortage lottery.
Right. I mean, the APs, they, from what we've heard and talking to them, they live for the times of shortages. Retail market is not really like that because the spreads are about the same, but there's no supply-demand fundamentals from the government side, the U.S. Mint, who they're buying from. So in the retail side, everybody's, when there's a shortages, all the wholesalers and the APs, they raise their prices because market forces, there's scarcity of supply, so they raise their price to equilibrate that so they're not totally out of stock of everything. But the government doesn't do that. The government just sells coins at $2 until they run out, and then they're out and they're out of production for a month. They don't raise their premiums when the market demands it. So due to that, the wholesalers and the APs, they have a massive arbitrage because the free market is pushing premiums up, but their fixed costs are not moving. So that's when they make their, I'd have to speculate, but I'd imagine it's a good portion of their profits. And looking back at the profits and sales for really the only publicly traded AP, which is A-Mark, you can see that in Q3 last year. I mean, they report their financials, so you can dig in and take a look at that. And I don't own any shares of A-Mark, but you definitely can dig in and look at it and see that that's when they make a killing compared to normal times. So,
well, one of the interesting things about this is it suggests that the primary dealers are changing their business model, tweaking it a bit for strategic purposes to maximize profits. But when analysts look at this kind of stuff and they see it, they may conclude that it is indicative of just excess supply on the marketplace, when it's more of an artifact. It's kind of like a short-term strategy to position each business going forward to capitalize on periods where there are shortages. Do you think that that's a fair characterization on my part?
Yeah, I would say so, Eric. I mean, it's not the excess capacity to the fact that they're drowning in inventory. It's a strategic decision that, hey, guys, we could make 2 cents an ounce right now, or if we take a hit and we sell all these coins that we're sitting on, and we've been stocking up on these coins all year because hoping for a shortage. It hasn't happened yet, so we're all about planning for the next shortage. So let's take a 5-cent hit, and if we're right and the U.S. Mint ends the allocation in a week or 2 weeks, we'll buy these all back. Our numbers will look great for the Mint, and we'll be heading in the right direction, sitting pretty for the next time there's a shortage. The Mint will give us 200,000 coins a week instead of 100,000 coins a week. And
then being able to sell them with extra premiums of $1 plus, which makes that 5-cent loss pretty trivial.
Yeah, I mean, you can do the math yourself. I mean, this Q3 of 2015, the wholesale market was commanding $5 or $5 plus premiums. I mean, if we had SD Bullion, we wanted to go buy a pallet of Silver Eagles, we're paying $5, or I think it hit $5.50 or $5.25, something ridiculous. At one point, the retail market was actually lower than the wholesale market, if you could believe that. It was only lasted for a week or two, but meaning I could buy coins from other retailers cheaper than I could from the mint APs. But so say that happens, they're getting a fixed amount of coins from the mint every single week, just strictly based on what their sales were the 6 months leading up to that, when there were plenty of coins in the market. Basically, the mint trying to make it somewhat accounting for the fact that, hey, if you got 10,000 customers and this guy has got 100 dealers, yeah, we understand that the guy with 10,000 customers is going to need a little bit bigger supply during the allocation. But as far as profitability, if you're the business, you're the AP doing that, I mean, if you get an extra 50,000 coins a week and you're flipping them for not doing anything, you're selling them before you even get them at a $3 spread. I mean, you can do the math. That's a big difference when you're talking about a potential multi-month period like that where you're getting an extra 50 or 100,000 coins a week. So as far as what it means short-term for the retail investor, I mean, I think it's good news for the retail investor. It means that there's enough coins in the market that the allocation is going to be ending here shortly, most likely. And as we talked before the show, Eric, you always have to throw in that caveat that the market can change any time. And look at what happened last year with Greece. Just that 1 week just ignited the market. And I mean, the U.S. Mint had stocked up, I think it was, we heard from what did Tom Power tell us? They'd stocked up 4 or 5 million coins. They thought it'd be good for the summer, and in less than 24 hours, they burned through that.
Right.
So it'll be a while before the U.S. Mint is able to stock up even that kind of numbers because, I mean, say they've able to stock up this week, they sell 700,000 or 800,000 coins, so they're able to stock up 200,000 or 300,000. Still be quite a while before they're able to build up a stockpile of 4 to 5 million coins. And as we saw that time, that didn't even last them 24 hours, and they sold through so much that they had to shut down for a month.
And in the grand scheme of things, when people make assumptions about overall market conditions based on these moves, I think it's actually kind of dangerous because it doesn't take that much to change the shorter-term period of slack that other market analysts are interpreting based on these shifts in the allocation.
And I mean, ultimately, long-term, the major mints haven't done anything to increase capacity the next time a massive shortage hits. A lot of the private mints have. Some of them have opened up, whether it's a new facility or they've brought a new press online. But the major mints, they haven't done anything to increase capacity one iota. So, again, when you see a big shift in demand, which we saw last year can happen overnight, once again, they're just going to be sold out and be multiple weeks before they have enough inventory that they feel like they can open things up for allocations again. And I mean, we've talked time and time again. We're still talking. What we saw last year was just a fraction of the entire U.S. market. I mean, if we are in fact in the early stages of the third stage of this bull market, they're going to be absolutely overwhelmed once the general public even think about testing the waters.
Yeah, and it's interesting as well too that the initial 6 months or so of this bull market reboot in 2016 has seen a great deal of paper buying. The Soroses of the world are not buying physical bullion; they're buying paper. He bought a big chunk of Barrick and GLD, and Druckenmiller is probably buying paper as well too.
And if you take a step back, it's really incredible to me that Silver Eagles have remained in allocation till halfway. I mean, we're still in allocation now, and we're halfway through June. When you take a step back and you look at the fact that, silver bottom months ago, it's $4 off its lows, and you don't yet have the excitement of the whole market feeling like they're missing the move and it's running up, and the Giffen Good type buying that bull market creates.
Mm-hmm.
So, I mean, you've had all the stackers that everybody who knows about the space put everything they had and they maxed out their credit cards at a 13 handle.
Yeah, I think there's something to this because, if you look at the different classes or the different categories of the type of people who are buyers in the precious metals world, this year we've seen a heck of a lot of buying from the conventional finance world, and they're largely buying paper. You see the accumulation in GLD, for example. I mean, yeah, of course, there's certainly a lot of reason to question what the heck's going on in GLD and all of that, but there's a significant tonnage that's been added in GLD and the other ETFs. And, with bullion continuing to move on, I'd caution people to not be looking at that change in the allocation as something that's a negative. I think your insight into it is that it could, in fact, be just an artifact of a different business model, and they're looking to ring the lottery of premiums in the future. Maybe we'll see some of that when the stock market rolls over and people in the stacker community begin to buy more physical as well too. At some point, the conventional finance world is going to be buying more physical as well, and that's really going to send prices a lot higher. And we've seen a lot of indications of that awareness happening. A lot more people talking about problems with whether or not the allocated storage is in fact allocated, and BMO's new ETF product was interesting. Chris Powell had published an article earlier in the week where he had spoken about elements within the prospectus. So this BMO product is really interesting because in the prospectus in and of itself, it's noting various things like, for example, the official sector isn't active in the gold market and can affect prices, which is an acknowledgement of manipulation in so many words. And the real honker of a statement in the prospectus, and I'll just quote it: derivatives risk, i.e. the use of unallocated gold certificates, exchange-traded products, derivatives, financial instruments, or any product that represents encumbered gold, as well as empty vault risk or gold bullion lending risk, i.e. the practice of gold custodian lending, pledging, hypothecating, rehypothecating, or otherwise encumbering any of the investor's underlying gold bullion. It's an example, in my opinion, of Wall Street trying to differentiate itself. We have BMO not being in the cornerstone of the manipulation operations like what we see with J.P. Morgan and HSBC and so forth. But they now are positioning this ETF product and singing its praises because it's physical, and the bullion is going to be stored in, bank of the Royal Canadian Mint is where they're going to store the bullion. So it's an interesting little anecdote because these kind of prospecti languages are not designed by accident. A heck of a lot of thought goes into it, and part of what is going on, in my opinion, is that they're trying to market to the leading edge of the conventional financial world that's waking up. And as the financial world wakes up and as they care more about physical and actually having real insurance that supposedly you're buying when you buy exposure to gold and silver, that's going to help bring the markets higher.
Yeah, it certainly will. All right, well, we'll certainly keep our eyes on the markets next week with the Fed meeting. Had a lot of good trading action this week for gold and silver. We'll hope that'll continue next week, but as Eric said earlier, we wouldn't be too surprised if the cartel is attempting to set up for a raid next week with the FOMC. So always have that in the back of your mind on a Fed week is my motto over the last 10 years. And 85% of the time you'll be right. Not always. Every once in a while. They can't let us know exactly what they're doing. Every once in a while they have to send the metals scorching higher on the FOMC days, but most of the time they knock them down. Thanks for tuning in this week. Call that a wrap for the Doc and Eric Dubin. Thanks for tuning into this week's SD Weekly Metals and Markets.